to cover, and there's just so little time to cover so much. So with all due respect, we will do the the emails in the second half. It's the monthly email grab bag where I get just slaughtered with emails, and I pick and choose and curate those which I think are relevant, and then I answer them. And again, I've got a bullet point list. We will get there. But in the meantime, let me give some commentary to the market today. This market is sick. It's in a bad place. I said this on Friday, and I warned every one of you. I said, when we gap down, and we gap down today, you're not getting out. You're not getting out today. You're not getting out for months. I warned you. This is the beginning of the end. It's going to be a grind. It's going to be slow, and it's going to be progressive. Do not buy this dip. Don't. You're making a horrible mistake. They're still panic selling defensive stocks, these knuckleheads, these idiotic managers. I'm going to sell at a 53 glove and 8 multiple, and I'm going to go and buy tech. Sure you are. Sure you are. If you don't rotate to defensive, low value, high dividend, this is the end. Okay, this is how it starts, where people buy the overbought, buy the relative strength, and it just rolls itself lower. You need to have managers rotate, or this thing's going to just air pockets everywhere. I call this, and with all due respect, I call this of mice and men. How many of you out there? Yeah, my Peter Schrader. How many times did I tell you that when I told you when Microsoft was 550, I told you it's going below 300. I said it'll take about 3 or 4 years. A lot of these stocks are going to be cut by 2 1/3. Young people, you haven't seen anything yet. I'm going to buy the dip. Sure you are. Go ahead and buy this dip. But when it goes down below 6,600, there's the air pocket where there's nothing for 600 points. Be aware of that. Okay, let me continue on. Anybody ever heard of Mice and Men? It's a famous book. Everybody remember Of Mice and Men? But it's also a famous poem. So let's go out there and let's talk about Of Mice and Men for a moment, because it's really apropos for today. I'm sorry to be a pain in the ass. I'm sorry to be the sort of punishing father. There he goes again. Okay, think what you want to think, people. So, once upon a time, Robert Burns, who was a Scottish poet, and by the way, I actually went past Robert Burns's house. I lived in Scotland. I studied abroad in Scotland at the University of Stirling, if any of you know it. I studied classical poetry. I studied Shakespeare. I studied the UK healthcare system. I spent nearly a year abroad in Scotland, northern Scotland, so I got up to the Highlands. I know it. I've been up to everything. I've been to St. Andrews, Aberdeen, to the very top across Scotland. I've been to Glasgow, Edinburgh, seen it all, but this is their poet Nobel laureate gentleman. He never got a Nobel Prize, but if he were alive, he would have gotten it. So Robert Burns wrote a poem once upon a time in 1785 called To a Mouse. And you're like, why do I care? Because you care. Because it encapsulates what's about to happen to this market, because the bottom's about to fall out. Now listen carefully. He was plowing in his fields when he unearthed a house that was buried there in a sort of an area where the mice, he lifted the mice house and the mice scurried everywhere. He wrecked the mice house. So the phrase originates from his poem called To a Mouse. Now, I'm going to say it in English and I'm going to say it in Scottish because I can do it. So it tells how he was plowing the field, he upturns a mouse's nest, and the resulting poem is an actual apology to the mouse. So this is my apology to you. You're going to hate me. You're going to beat up on me and send me hate letters, but I warned you. I said, never look for a reason to sell. I buy low, I sell high, and that's how I made millions, people. That's it. There's no hey, there's a VIX. I don't give a crap about the VIX. I just make money based upon opportunities to buy low and sell high. I don't care what happens in between, okay? So here it comes down to this. So the quote goes like this. It says, but Mousie, thou art know thy lane, which means you aren't alone. Improving foresight may be vain. The best laid schemes, and of course in America we say plans, the best laid schemes of mice and men gang off the gly. And gang off the gly in Scottish means often go awry, okay? And ere leave us naught but grief and pain for promised joy. What does this all? What the hell is Bierman? Where am I taking you all? Okay. I sat here and listened, and I love the guys. I'm not picking on them. The people on CNBC, the bulls, everybody, they're going higher. No, we're not. I told you we can't go higher till we go lower. We're overbought, we're overpriced, we have no risk. And the Genesis Cog weekly indicator is never wrong. It's never been wrong. It just rolled over. This is the beginning of the end. It's going to take a long time. It will take 6 months to break the market, or 6 days. I'll give it 6 months. The bottom line is, a lot of you are bullish. Nothing wrong with that. Nothing wrong. It's been a bull market. But the best laid plans or schemes of mice and men often go awry. Your bullish plans have just gone awry. Now what the hell are you going to do? Did you just buy yesterday? I bought AppLovin, you're down 40. I bought Microsoft, you're getting killed. I bought Meta, you're getting blowed up. What are you doing? What are you going to do now? Are you going to buy on the dip? Really? We've only begun. All I know is I walk in every day and I'm like, I call myself, okay, Confucius. The path to enlightenment is admitting you know nothing. I don't know what's going to happen every day. I just don't. All I do is I look at setups and I go, there's risk there and there's risk there, risk to the upside and risk to the downside. There is so much risk to the downside. We could fall 2,000 points and not catch a bid, people. We're not even close to being oversold, Garrett. Not even close. If we sold off to 5,000, that wouldn't even scratch the surface of 10 years of being overbought. So it's going to take a long, long time to break this market. We're not going down in a day. But this is the start of how it begins for the algorithms to destroy trend and momentum. This is where it starts on a day like today. The advanced decline, we're going to buy on the dips. No, you're not. Go ahead and buy. It's just going to melt worse. The algorithms don't buy the dips. You do. They're going to sell the rips when they rope in enough people. So of mice and men is just letting you know, despite careful planning, which a lot of people didn't do, unexpected events can disrupt even the most well thought out intentions. Did you play for risk? I did. I loaded up on shorts and sold dozens of positions on Friday. I liquidated Ball, Bristol Myers, Schlumberger. I just took gains everywhere I could, bought short, took short positions to try to hedge off this risk. That's what I did. Am I losing money? Yeah. The market's down 79. Of course I'm losing money. But I'm not losing that much because I looked at the situation, the risk reward, and we talk about this ad nauseum on TheoTrade. If you don't have the risk reward down, you're just roadkill. You know it. You just don't want to admit it. So this is the day where you just woke up, you permabulls, your plans have been destroyed of mice and men. You have to always plan for what could go wrong and what could go right, and then let the chips fall where they may. A lot of you just played for going right and bought the dips. It's too late, people. It's the beginning. The best laid plans have now gone awry. Now, here are things that are afoot in this market, okay? First off, I call it island fever. It's a terrible pun. I admit this one. Bad pun. Bad Jeffrey. But here's the thing about island fever. Just take it for what it's worth, people. We're talking about Greenland as in the island. So President Trump announces tariffs on EU over his plan to acquire Greenland. The UK pushes back. We're in a pissing contest. They're yelling. Denmark's upset. Greenland's now liquidating billions of dollars worth of stock in the US. It's a liquidation. People, we're being liquidated today. And this isn't about tariffs. This is just about, we're so stupid overbought and stupid overvalued. Whatever it takes to get the market down, I'll take it. Like if Trump had basically, let's say, a foot injury or he had a blood clot, that would drive it down. If Powell came out and all of a sudden that indigestion had to go to the hospital, that would have drove it down. The market's looking for any excuse to sell, people. Didn't you figure that? When are you going to figure out? Markets look for any excuse to buy, and they look for any excuse to sell. We're not in a bull run anymore. We're now the beginning of a we're not a crash. It's a corrective move. So this is what put the wheels in motion, okay? I call it island fever. But I want to show you the setup so a lot of you don't go out there. Please don't buy this. Don't. You dippers, stop. Take a look right here. Are you underneath the 50 RSI? Check that box. Can't buy. Is the trend on the way down? Check that box. Can't buy. Is the MACD rolling over? Check that box. Can't buy. Is this histogram showing underneath the zero line? Check that box. Can't buy. What about the accumulation distribution? Kind of flat. That's the only bullish sign you got. That's it, because the dippers are going to play it. The stochastic on the way down. You broke underneath the algorithmic channel. Game over. It's over, people. We may go between 68 and 7,000, but that's just going to open it up for like more people to buy the dip to drive it even lower. You're going to build another liquidity node here, which is going to jam this down even lower. This is a bad buy. When you break that, you need to start to hedge. You've broken the momentum. If you break 6,600, which it's on the way, you have officially broken trend, and now you're in a corrective 5 to 10% move. I wouldn't, if you guys put $1 million in my pocket, I wouldn't touch this market. I wouldn't buy this with your money, not at all. I would short into this. Any rallies should be shorted. Any and all rallies, short them. Even here is a short. The more important point is the weekly. I put a premium on the weekly. Here's the thing, people. I don't think, I guarantee, 100% guarantee that weekly is going to correct. At some point, it's going to correct hard. It has to. It's a cycling mode, people. You can look for all the fundamentals you want. I don't care what your reasons are. Just get out. It's math. It's statistics. The algorithms will now do their naughtiness and drive this lower. And the money managers will wake up and go, I got to sell this and sell that. They're going to sell 52-week lows and panic on the value stocks. That's what they're going to do. And then when we get through 6,000, they're going to go, dang, I need to own those value stocks. But of course you do. Okay. Take a look right here. All you need to do is look. The histogram bars are starting to build. It's slow. It's really, really, really slow. I told you, it's going to take anywhere from 6 weeks to 6 months to break this down. That's what it's going to take. The algorithms will defend this to a degree because the trend is up. But because you broke the momentum, okay, any and all rallies should be sold into this on this particular product. When this starts to approach that zero line, and when we get through this 50% on the RSI, on the weekly, not the daily, but the weekly, that will then force the issue and drive this over. I called it rip curl. This is the beginning of a Hawaiian pipeline rip curl. Look at it yourself. You're looking at here. I'm not looking here, people. I'm looking over here. Be really careful. If we rally up, we're down 50, me buy, and we reverse and drop 150, this thing's going to explode and blow out, people. Big deal. You're down 2%. BFD, 2%. You're basically up literally 100% from where you were like a year ago, almost, literally. So just keep in mind, think math, contextualize it, and think percentages. We're in a danger zone. I don't care what your reasoning is, okay? You're going to find the reasoning too late. I should have sold when I could have. Shoulda, woulda, coulda. Sell when it's up, buy when it's down. But this is the beginning. And what's even more confounding to me is, and this is what Blake and I have been kicking around. Blake and I talk behind the scenes on Telegram, and Blake and I are going, we just keep shaking our head. This thing's going to blow on stagflation. Blake and I are like going stagflation. We got stagflation, people. We got stagflation. It's everywhere, okay? Food keeps going up. Healthcare keeps going up, okay? And even gas prices are going to go up. Now you've got natural gas prices going up. People, wake up. Samurai synchronicity. You like that? Samurai synchronicity. So U.S. Treasuries have now joined Japan bonds in a global meltdown. Japan yields in Japan hit their highest 30-year yield ever. They're right on the doorstep of 4%. It's about a 385 handle, 385. I've told you time and again, if we go through 5%, it's the end of the bull market. That's it. That's the number. Take a look at the CGI, okay? TYX is your 30-year bond, CGI, okay? It does not lie. Stop with your opinions. Look at the facts. You're in an ascending triangle, okay? All you need to do is get above that 5%, and it's a game changer. It's been walking itself up since October. The Fed just doesn't get it. Powell is a moron. He doesn't understand. He's trying to kowtow to the markets and use the job numbers as an excuse to cut rates because he's pandering to Wall Street. He sees all the money pouring into these 401ks, chasing stocks. He's afraid of a market meltdown. So he keeps cutting to try to sort of shock absorb the meltdown. But by cutting, it cuts both ways. Because by cutting, he's creating an inflationary environment for overspending. So take a look at what you're seeing. This is a weekly. It's a weekly. If we get through the 5 handle and look at the MACD and it rips higher and we go through 5150, people, I am loading up on CDs at a bank. I'm going to get that 5.5% for no friggin' risk, people. And you can go and try to buy the market and catch it on the way down with basically a 20 to 25% standard deviation handle. You will actually have an anxiety attack each day you wake up. Okay, bonds are more important than stocks. We all know it. Garrett knows it. Blake knows it. Brandon. We all know that. Even Gianni knows this stuff. Okay, if it gets through, you get a 5% yield for half the risk. The risk reward, the mean variance criterion dictates that tactical asset money will shift into that asset class that will come from stocks to buy that. Don't buy this dip. See what happens with the interest rates. We're in dangerous times. We are synchronized with the Japanese bond market. They're at a 3.85 handle. We're now at a 4.9 handle. Move the decimal one over. Once we get through there, if we get through there, and it certainly looks like it, okay, it is going to be a bull market stock killer. It's a game changer. That's what I'm telling you. The last thing I want to throw out is this: slip and fall. Okay, where am I going with this? Okay, this is purely facts. I don't know if the market's going to drop 25% or 50%. If it did, I wouldn't sit here and go, that's weird. I would look at it and go, what took you so long? But because I know how the dippers can't control their bowel movements, their diarrhea of spending, they're like, it's 5,000, I'll buy. We probably, but think about this for a second. It's a fact, and I'm just bringing you facts because you know Gianni loves bringing you facts, and I'm willing to bring you facts too. The S&P 500 has had at least one 5% pullback in 94% of trading years going back to 1928. Okay, TheoTrade members, just digest this for a minute. You have a 95% chance, probability, of a market correcting 5% every effing year. Why the hell would you buy here? Overbought, massively overpriced to a degree in many sectors. We haven't had a basic correction since April, okay? And you've got all these headwinds coming at you. You've got zero tailwinds. And the Fed, I said this 2 weeks ago in my Bierman prediction for the year. What did I say? The most we get, we might get one rate cut, but I'm betting on zero. I don't think we're getting any. But if we get one, I'm like, yeah, maybe one. You can't cut rates when you have inflation numbers and it's being basically played out in the gold market. It's being played out in the silver market, the copper market, the palladium market. We got problems, people. Go look at Archer Daniel Millen. Now it's in the soy market. It's in the wheat market. It's just starting, okay? So here's the other factoid I want you to kind of swallow here, okay? This is something else you just have to be aware of. Here's another factoid. On average, this is an average, time-weighted average. The index, the S&P 500 index, experiences 3 drawdowns per year between 5 and 10%, okay? Think about that. It's an average. So for the last 98 years, the market has had, on average, per year, 3 drawdowns of 5 to 10%. Then why the hell would you buy this? Why wouldn't you wait for it to drop 5 to 10% and go, whoops, there it is. You know, like that song, whoops, there it is. Wait, I make money not by buying. I make money by doing nothing. Me not buying here tells you, okay, that I'm actually preserving capital. I've got 50% cash in all my accounts. I'm loaded with cash. I'm not buying here. Are you out of your mind? That could drop another 8%. And even then I wouldn't buy because the markets tend to overshoot. So I'm going to give it 15 to 20%. Then I'm going to go in and buy my favorite tech stocks and my favorite cyclicals. But to buy here is suicide. Okay, the risk reward makes absolutely no sense. The one thing you cannot control are these algos. Algos don't buy dips. You do. They sell dips, okay? The only buyers of dips are people who buy dips into upslopes. We're not on an upslope. You can buy on the dip when it's sloping upward. We broke it. Now it's slipping downward. Give it time. People, be patient. Let it work. It's not going to drop 200 today. No, but it's down 84 today. Wake up tomorrow. Where's it down? Might be down 30, might be up 30. Use the bump up to sell. Use the down part to, like when the bump up, to hedge more. Use the down to buy stocks that are deeply oversold and they're priced wrong, and you can buy them in a defensive mode for a rotation. That's what I would do. Now, just talking about individual stories. Okay, I don't have all the answers in tech. And I want to put this in perspective. When I ran a hedge fund, when I was a Wall Street analyst once upon a time, my assignment from the firm I was with, I covered small cap semiconductor equipment stocks, which is why Gianni and I can banter back and forth about semis and tell you what to buy and when to buy. That's my strength. I know semiconductor equipment, and to a degree, I know semiconductors. I'm good at that. But I'm not really good at hardware and software. It's not my bag. But I finally understand why. And I was like, why is like Microsoft and Salesforce, why do they look like garbage? I got it. You want the answer, people? You can't handle the truth. Well, you're going to handle the truth. People, you're in trouble. Do you own Microsoft, Peter Schrader? You're in trouble. There's a reason why Microsoft, and there's a reason why Salesforce.com are in a bear market and they're in a toilet. You want to hear the reason, Peter? Everybody want to know? I got it. I pulled it out. I figured it out. I unearthed it finally. The reason, and I call it ain't no reason. Ain't no reason. That's what I call this. That means there ain't no reason to buy this. Don't buy these stocks because they're not cheap enough to buy. They're not cheap enough. The software sector has faced significant challenges at the start of 2026. Why? Because the release of new AI, artificial intelligence tools, particularly from startups like Anthropic, has reignited fears that traditional software companies may struggle to compete. Guess what? AI is actually making Microsoft less worthwhile. Salesforce.com is worth less because of AI. AI is replacing a lot of these software engineering companies. That's the point. It's resulted in a notable decline in stock prices. Adobe, Salesforce, Microsoft, fear of disruption, lack of AI traction, market performance. People, AI is not just benefiting AI. It's benefiting AI, and it's benefiting retail to a degree, but it's hurting software companies like Salesforce, like Oracle, like Microsoft, like Adobe. That's why these stocks are going down. It's not that they're going down because their products are not good. It's just that a lot of what they provide is being displaced. It's being displaced by AI. I love AI. You love AI? Well, then you should be selling Microsoft because AI's gain is Microsoft's loss. That's the truth, people. Now you know. They're going down because the proliferation of AI makes these companies worth less. Factoid. So I call it Ain't No Reason to Buy. I love that song, Ain't No Reason. All right. Number 2 here from the current slide. Continental divide. We got problems. We got problems with you people. Okay. So guess what? Pfizer's down today. And Bristol Myers, which I sold all of it at 55 to 56. Out of the contest, people. I'm completely out. It might go back up, but I'm out of it anyways because I'm not going to, I'll buy it back I bought it in the 45, 44 range. I got out of it, made 10 bucks. It's good enough. I'll take it. But I'll tell you this. These stocks, okay, this is a problem. The European Union has said, quote, okay, You cannot come over here and raise prices. Trump has said you cannot raise prices over in pharma for your pharma suite of products. So they've pivoted to sell pharma more overseas than at home. Both Bristol Myers and Pfizer has. Oh yeah? Guess what? Bristol Myers and Pfizer said to the European Union, you're going to pay these prices. And the European Union said, no, we're not. And Pfizer said, you're not? Well, then we're going to withdraw our drugs from your particular continent, continental divide. And if we pull them out of your continent, guess what's going to happen to the price of your home drugs like AstraZeneca and AbbVie, which are British drugs? They're going to double. The fact is, by us exporting drugs and pharma over to them, it lowers the price of healthcare medication for them. Trump is like, you can't raise it here. So they're saying, well, we have to make up down and distance. So they're raising prices over in the European Union. And the European Union says, you can't do that. And then Pfizer's like, we can't? Great. If we can't raise prices, then we'll pull up all of our medications out of there and you won't have what you need. There's the issue. So if ever there's a reason to be bullish on Pfizer and Bristol Myers, you got it. The fact of the matter is, these stocks right now are not making a move. But if Europe does not kowtow to Pfizer and Bristol Myers raising prices overseas, these stocks may stay here. But if they don't, eventually the European Union's like, you know what, we better give in. And once they give in, these stocks will take off. So be aware, these stocks are being restrained by the European Union. Just be aware of that. I call it continental divide. You like that? Continent. Oh, there's a pun there. All right. Number 3, Horton, here's a who. Oh yeah, it's from Dr. Seuss. That's from Dr. Seuss. Oh, Bierman, he's trying to be a comedian. Listen, what better to be a comedian when I'm getting my ass kicked on the long side, right? So here's what I'm going to throw out at you. Horton, here's the who is this. So DR Horton reported today. Okay, DHI. Now, DR Horton's one of the largest, home builders out there. So the stock backed off. It's kind of bounding around here. They reported $2.03. Okay, they did beat, but there's a problem. What's the problem? The CEO said, despite the fact that we beat, okay, we can't raise prices of our houses. Why? Because the consumers pushed back and said, your houses are still not affordable. So be aware of that. This is an issue you have to deal with. I don't know where this is going. I don't. 13 multiple is very, very expensive for a housing stock. So what I'm telling you is this. If you own the stock, you better hedge it. Because when this stock is cheap, it gets to a multiple of 5 or 6. So on a PE multiple side, it's very expensive. It is expensive. But the issue is that they are still making money without raising prices. The question is, are they going to cut prices or are they going to raise prices? If they raise prices, that could drive this higher. But if they cut prices, you're thinking it may drive it higher? It might not, because they may cut it to their margins. So they're between a rock and a hard place. They barely made their number, but the CEO is saying we still have an affordability issue out there. I don't know how they're putting up this number. I don't necessarily trust this number, but be aware the number went from a 240 handle to a 203 handle. That's a sequential decline in earnings for this company. That's not good for nobody. Would I buy this? I would not. Would I short this? Not necessarily. But if I owned it, I'd be stepping in there to buy puts. I think it's way, way, way too early to buy housing stocks. I do. Because if the mortgage rates go from that 630 handle over 7%, that will wreck their business. The only reason why this stock popped is because the mortgage rate came from 7.5 handle to a 6 handle. If it goes back up to a 7 handle, this stock is done with. All right. Next on the list. Yeah, the drug makers are threatened to withdraw from Europe, and that's not a good thing. Last but not least, okay, I don't think a lot of you are going to understand this pun at all, and there's no offense. I'm not offended if you don't get it, but I got to bring this pun directly to you. So just bear with me when I bring this pun to you. I call this pun bad rap. So if you actually go into 3M, they are a well-diversified industrial cyclical stock. They make a lot of stuff. They make scotch tape, post notes, but they make a lot of wrapping products. That's where the pun comes in. It's a bad wrap. Get it? Wrapping products, packaging. They make a lot of packaging products. So here's the deal with 3M. Why is the Dow down 500? There's your answer. Whoops, there it is. See it? That's why the Dow's getting whacked. Because 3M, and she's in the Dow. Okay, couple of things. Number one is they reported $1.83. The estimate was $1.70. So they beat by 3 cents. Apparently, it's not good enough, okay? They did make a sequential jump from $1.68 to $1.83, so I'll give them that much. But the issue I have with this is this, okay? I've said this 1,000 times in the last 2 weeks on Theo, okay? If you work for me and you don't hedge this, you're fired. If you work for me and you don't sell there, you can consider yourself fired. Security, I'd rip that card out of your hand. Get out of my building. How dare you not sell this? People, it's gone from 122 to 175. What do you think is going to happen? Do you think it's going to 250? It's a friggin' cyclical stock. Go look at the valuation. It's 24 times earnings. It used to be, when it was $99, it was at 11 times earnings. That was dirt cheap to buy. Dirt cheap. This ain't cheap. No cyclical in the world should trade at a multiple, any multiple, ever, over a 20 to 15 handle. That, my friends, is a layup trade. Get out of this, sell it, do not come back, do not buy this, let this go well under 120. That stock is not a bubble, but it's the closest thing to it. It's a bad, you took a bad rap. No, it's the market's doing exactly what it should be doing. Selling into a stock because the earnings just are not good enough to justify. This implies, if the earnings are going up this much, which is basically 3 cents, then why would you pay for a 24% growth rate when they're growing at less than 2%? Why the hell would you do that? That's not very bright. You buy the stock because it's sequentially growing at 10 to 15%. It ain't. It's too big to grow at that much. So for those of you who caught this short, congratulations. Good for you. And for those of you who didn't get out, too bad. You should have got out. Next time, send me an email. I would have told you to sell the whole thing. I don't even care what the earnings are. There's no reason to own a stock at 24 times earnings, but the market is now acting sane. Sanity means stock goes down because it's overpriced. Sanity also means stock goes up because it's underpriced. It's overpriced. Next. All right, let's do the coaching session of the day. It is a strategy coaching session. People are like, it's a strategy coaching session? Where are we going with this? And it's like, well, I'm not sure where we're going to go with this, but we're going to go some places. Some of my shorts are working okay. Some of them are not working so well. Yeah, it's a flat day. It's okay. All right. So the first one I'm going to use is, and I'm not going to go in any particular order. These are emails that are sent to me for questions about technicals, questions about fundamentals, questions about indices, just any kind of wild. Now, if I know the answer, I will answer. If I don't, I might just farm it around to one of the other instructors and let them handle it because it's their expertise. But the first one comes in from, and no names need to be mentioned. It's just straight up, somebody came to me and said, what do you think of this? So this one came on December 18th, and so I'll bring it to you. A lot of you might have heard of the reverse engineering MACD. Now, the MACD is my absolute, unquestionably, undying favorite indicator of all the time. I believe the market is completely engineered, manipulated, rigged, run, controlled, call it whatever you want, by the MACD. The slope of the MACD and all the different mechanics that go into it, okay, determine your fate of prosperity, or whether you're basically, what I see, you grow your wealth or you blow your wealth. One or the other. It's either or. It's in the hands of that one indicator, and the other ones complement it to help you understand what's going on. But the integrity slope is the most important. The steeper the slope, the harder it's going to be sold off. The steeper the slope to the upside, the more it's going to be bought, chased, and the greater the risk, but the greater the return. Because risk and return are directly proportional. They move together. They're correlated directly. They're not inversely correlated. So he asked me about the reverse engineering MACD. Okay, for me to explain what this does takes an entire coaching session. So you're like, well, let's talk about the reverse engineering MACD. Well, I did one on the reverse engineering. I've done a number over the years on the reverse engineering MACD. So Good old Aaron, love the guy, says to me, explain this to me. Aaron, for me to explain this by typing it up would take me 5 hours. I can't, it's too long. There are too many subtleties. There's too many mechanics at play here. So what I'm going to tell you is this, people. If you want to learn about the reverse engineering MACD and the power of it, I'm going to copy the link. And what I'm going to do is I'm going to put it in the room. Okay, I'm going to put it right in the room. And you can run with it. I'm going to give you 3 of them. The reason why I do this is this. With all due respect to every member out there, I don't mind getting emails. But the thing is, I would prefer, my preference is this, given my schedule and all the things that I do, okay, my preference is this. You go to my personal archive, go to Don's archive, Brandon, Corey, we have these incredible archives, and they're broken down by category. Go into the archives and go look through the archives, and you'll usually find what you're looking for. I pulled this straight out of my personal archive, and this is from July 16th to July 18th. I'm going to copy the link. There is a 3-part series, and you can go buck wild, okay, learning about the reverse engineering MACD. All this indicator does is one thing and one thing only, and I'm just going to bring it up so you can have a look at it, okay? And I'm going to remove all what's on my screen. Take it off my screen. Remove it all. Okay. Reverse engineering does not. I want to point this out. So listen up, all of you. Okay. Because a lot of you make this horrible mistake. You listen to a lot of people and it's going here. We don't know where the hell it's going. Okay. We are educated guessers. The MACD, reverse engineering MACD, does not say it's going here. That's not what it says. It does not predict. What it does is it shows you levels of volatility mapping based upon the MACD formula projected forward. That's all it does, people. It just says, so where's the risk on the market? I'll bring it up for you quickly. Okay, here's the E-mini. Here's the E-mini. Look, it's not saying the E-mini, it's going to go there. Nothing ever tells you. It's just lie. People lie all the time. All this is saying is, based upon the E-mini setup, okay, that based upon a 3-month MACD setup, that if, and this is interesting how it's trying to fight its way back up here, but right here, all it's telling you that is that if the MACD were to reverse, today, if it were to reverse, it could reverse to 7,037. But if the MACD continues on its path right now, the way it's playing itself out, okay, the risk is to 6,806 today. Will it go there? Nah, it's not likely going to go that far. No, it's not going to happen. What it does is it just sets you up and says, where is my drawdown risk and where is my draw up risk? That's all it does. There's your MACD right there. That projects up, that projects down. If this is to reverse, the risk to the upside is 7,038. And what's the risk to the downside? 6,807. That's what it says on a daily chart. If you were to look at this and say, well, what does it look like on a weekly chart? I'll bring up a weekly chart for you. I'll bring up a weekly chart, weekly. Look, a weekly chart says, okay, that if the MACD were to fall out of bed today, it broke, the risk is to 4,900. So on a daily chart, the risk is to 6,800. And the daily chart means nothing to me. It's worthless. It's the weekly that's way more. The secret sauce to the market's the weekly. That's the thing nobody ever tells you. The daily means nothing. The weekly runs everything. There's your risk. That's why every time people come at me for an interview, I want to interview Bierman. Where's it going? I told you. I don't know where it's going, but the risk is to 5,000. We have a 2,100 point risk from where we are right now. It's actually 2,000. Will it go there? Don't know. But if it goes there, don't say I didn't warn you, because the MACD is never wrong, ever wrong. It doesn't predict. It just shows you volatility risk mapping of drawdown and draw up. And it does it better than any indicator period out there. There's your risk, people. That's it. If you're wrong, you're going to take a hit down here. Don't say I didn't tell you so. Next. All right. So I'm going to move on to the next one. I don't know how many I'm going to get through, but it took a while to get through that sucker. All right. Next question I have is this one. And this is another email. Somebody said to me, ask me, what is the integral difference between Fibonacci arcs and Fibonacci retracements. And that came on 12/27. So I'm going to have to go backwards in time. And here we are, 12/27. I'm right there. Okay. Here's the difference between the two of them. Okay. And I'm going to just bring up the E-mini. I don't even care. I have no position in it, so I don't care. But just for kicks, I'll bring this up on, let's say, a yearly basis. 6 months is fine. I think a year's too much. So let me go out to 6 months daily. The primary difference between, and I did a whole thing on Fibonacci arcs and Fibonacci retracements. So there's your Fibonacci fan. That's your Fibonacci time extension. That's your Fibonacci arc. So I'll click on the arc. I'll create the arc. Okay, there's your arcs. There's your Fibonacci arcs, right? And then he asked me, well, what's the difference between the Fibonacci arc, okay, and the Fibonacci fan? So I'm going to go grab the Fibonacci fan for you, right? Fibonacci fans. I'm going to overlap it, which is what you're supposed to do, and draw it. And there you go. So those are the arcs, okay? Those are the fan. Fan is linear, straight out. There's your fan. See, I have a little pop-up box. That's Fibonacci arc because it curvilinear. You can see it. What's the primary difference? Promote. Here's the primary difference. The Fibonacci retracements. And I'm going to go to the retracements and I'm going to show you those. And he actually asked me the Fibonacci arcs and the fans to the retracements. So I'm going to actually go to it. And I'll pull up the Fibonacci retracements too on this one. So here's your Fibonacci retracement right here. The primary difference is this. So here's your Fibonacci retracements in blue. The primary difference is the Fibonacci retracements are designed for long-term position trading. And when people say, what do you mean by long-term? Long-term to me means anything 6 to 9 months, 9 months or more. 9 months or more. The arcs and the fans are what's known as intermediate to short-term, okay, trading duration positioning. The extensions are short-term only. So retracements are long-term, 9 months or more. Fans and arcs are intermediate, 6 to 9 months. And the spiral and the extensions are short-term. The Fibonacci spiral and extensions are short-term. So you have Fibonacci tools that are made for short-term, mid-term, intermediate, and long-term. That's the primary difference. That's the question he asked, and that's the way I answered it. I hope this clears up any misconceptions because a lot of tools are not good for short-term and others are not very good for long-term. You have to understand what the tool is and what the duration is designed for. It will help you immensely. Next. Okay. Question. I had a question from the difference between Schlumberger and Devon. Now, I want to be abundantly clear on this one. Like truth out there, truth be told. I am long Devon, but I'm not long Schlumberger anymore. I sold Schlumberger between 45 and 46. I walked away from that trade. I did phenomenal. I bought it at 32. I sold it at 46. I made $14. It's about a 35, 38% return. I'm done. The Genesis COG is done. But we're still in the Devon trade because there's a lot more upside. So here's the deal. This comes from Adele who had confusion. And she said, okay, here's Devon. And I want to pull it up because it came on January 5th. And she asked me, and I want you to look at this on a 3-month daily basis. So here's January 5th, right over here. All of a sudden, Devon gets absolutely smacked. Smacked. But Schlumberger, which I also owned at that time, I owned it simultaneously. I owned it here. Actually, I bought it way over here. That's me. I bought it over here. Then we sold it over here. That's us getting out. Okay. But she asked, why on January 5th did Schlumberger take off, but Devon tank on the same day? Here's the answer to all of you. And this is why I preach this all the time. I don't think anybody at TheoTrade is probably better than probably Garrett, but I would put Blake and Brandon up in that pantheon of just brilliance of research, because I'm not as smart as those guys, but I can tell you this. Everything I buy or short, I research it constantly. I try to know as much as I can. I can't know everything, but I know enough to be dangerous. I'm like, I'm going to buy something I know nothing about. Oh no, there goes 80 million, there goes 80% of my money. Shame on you. Why would you buy something you know nothing about? Frank Walsh, like one of my godfathers, and Don's too. He always used to say to me, trade what you know what you trade. So when I trade things, I know it way better than like 9% of the population because I'm putting my money at risk in the Genesis cog because I'm out there owning it, okay? The reason why it jumped is because Schlumberger has operations base in Venezuela already. So when Trump went out to take out Maduro and take him out and did that raid and bring him back to the United States and put him in a New York jail, that day, remember, it was a turnabout in the oil market. The oil market was going wishy-washy. Devon went down because Devon doesn't have operations there. Schlumberger did. So Schlumberger was the beneficiary of the coup or the takeover in Venezuela. That's why it ripped. Did a lot of you know that? Well, now you know. The next time you go out to trade something, don't you ever tell me, I don't understand it, but I'm going to buy it. You better know it. Even if I recommend it on the Genesis cog, you better be out there knowing what you're buying, because I don't want to be responsible for you losing money because you don't understand what it is. I try to explain it to a high degree what it is, but if you don't feel comfortable from what something is, then why the hell would you buy or short that thing? You should feel comfortable. Don't trade and go, biotech? No, nothing. I'll just roll the dice. Well, that's that's a risk of ruin setup right there. I can see it already. You won't last. Know what you trade. I knew immediately when they did the takeover. I woke up, I was like, Schlumberger should open up 4. Exactly. Because I knew they had operations there. Did I know that Devon didn't have operations there? I did. I just thought that Devon wouldn't take the hit. It did take the hit, but who the hell cares? Because Devon took the hit and it came all the way back. So Jimmy Crackhorn, I don't care. I own this. I don't care. This is going to just my work shows me technically it's got to make a run for 43 to 50. The PE ratio is obscenely low. It's going to run. Garrett owns Apache. I own this. There's your answer. Okay. Next. That was an answer to like fill you in on why Schlumberger versus Devon made that move. Okay. Here's another question. Okay. And I love this one. This is one of my favorite ones, and it came in on January 14th. So let me pull up this email, if I may. Okay, so this came in from Mark. So let me pull this up for you, okay? And this is what I keep talking about doing your homework. And I cannot emphasize this enough. I can't put this number up enough and emphasize this. And if you just don't want to listen, that's on you. People ask all the time, how do I crunch the numbers to get that PE multiple? I said, okay, I'm not slamming toss. I worked there for friggin' 9 years, 8 years, people. Okay, so I'm not slamming them. I still trade off of it. I have a number of accounts there. I'm just pointing this out. Don't ever go in here and trust that number. Ever. Don't do it. Either go to an outside source like Brandon does, go to schwab.com, go to Yahoo Finance, go to Morningstar, okay? Don't ever trust this number. This vendor is a different vendor than that vendor. Did you hear what I said? The chart vendor is different than the trade page vendor. They're different. They pull data from 2 different platforms, 2 different silos. Did you know that? Data silos? You didn't know, now you know. So what you do is you go down, you look at the bottom, and you look at what the number is provided down here, and the numbers are provided, -8 cents, -7, -18, -20. See that? See that? That's what I'm telling you. You have to add up the 4 quarters and divide it into the price, and then you'll get the PE ratio. This is what Mark sent me. He said, Professor Bierman, I listened to you on several occasions, if my morning allows it, and one thing I heard you say is don't trust the analyst sheets. Go back and count the earnings per adding up the earnings yourself. He's like, I was researching Oklo. OKLO this morning, looking at Thinkorswim and saw a PE ratio down there of $4.64. Okay. The ensuing quarters in 2025 were losses were 20 cents per each quarter. So what had happened was he went to two different places to look at it and he didn't understand it. So he went to different sources. And so he went into Copilot for Microsoft, and it says it backs up what you say every time, looking at the PE ratio. He sent me a copy of the numbers themselves, which I don't need to reproduce because I want to hide his name and give him protection. But I want to just throw this out for all of you out there, okay? Don't ever trust the numbers you get up here. What you need to do is you need to go down, add up the last 4 quarters on this platform, then go to an outside vendor, Yahoo, Morningstar, Copilot, go outside, compare those numbers to the numbers you add up here. If they resonate, then the numbers are probably right. If they jive and divide, you're rolling the dice. Be very careful on how you price these things, because ultimately nobody cares about fundamentals until their accounts are blown out. Then they go, well, if I had known it was 118 times earnings, I wouldn't have bought it. But of course you wouldn't have, because you never did the research. Do the research first, then buy the stock. Don't buy on the chart. The chart tells you when to buy. It doesn't tell you why to buy. I'm telling you this. This market is setting up for something wicked this way. We're getting a correction, people. One way or another, it's coming. And the more we go down, the more you're going to spend time doing fundamental research. And by that time, it's going to be too late. Do the research beforehand so you know exactly where to exit and where to get in. And don't put up with like too late on this. I love this email. It just validates my point. Every time I go out, I go to different vendors to make sure that the numbers jive. And if they don't, I got a problem, and I probably won't. I got to find out what the real numbers are. I'll even go to the company's website to add them up and make sure. But I'm not going to sit there and trust this. It's not that Thinkorswim is malfunctioning or faulty. It's not. They're not paid to validate the data. You are. Buyer beware. I just want to throw that out there. Next on my list here of points here. So here's a question that came to me asking me, is this a pennant formation on a given stock? So if you've never seen a pennant formation, I'll be happy to provide it for you. It's on December 30th. So the stock itself, and let me bring it up to you, was Budweiser. And she said, would you consider this a pennant formation? And this was on December 30th. So as it were, okay, I'm literally down to no shares of Budweiser. I'm down to, I bought it around 55 to 60, went to 65, came back down, bought it back at 60 on the trend line. Then I blew out of almost all of it at 69. Not quite 69, but 68.75 was basically like the end for me. I'm ready to blow out of this completely. But she asked me, okay, is this a pennant formation? And let me give you the exact day that the email came in. And the reason why this is so important for all of you, and all of you should be listening to this, it's really important because of the way algorithms manipulate and basically hijack the market, because you're just roadkill if you don't listen to this, okay? Algorithms are programmed around pattern recognition. And one of the most common patterns in the entire market, okay, and people are like, what's the most common pattern in the entire market? One of the most common patterns is pennant formations. Pennant formations. So the question came in on December 30th. Is this a pennant formation? And the answer is yes, it is. And let me show you why. Okay, but it's difficult to see if you don't kind of play it out. So here you go. Okay, I'm throwing this out there. Okay, this is what we call a pennant formation. Okay, it's a flag form. Not quite. It wasn't. Pardon me. A pennant formation came up to. It was right up to a certain point. So let me back this one out and get it right. Remove the drawing. So the pennant formation was right up to this point. Okay, I need to get the straight line. What am I, new? Okay, so I came down to here to the 30th. And she asked me, is that a pennant formation? And I said, yes, it is. That is a pennant formation. That's a pennant formation on Budweiser. Okay. That is the pennant formation. It is. The fact is, do I know where it's going? I don't. But you know one thing, when it comes to the apex of that pennant, either it's going to rock higher or rock lower. It will break when it gets to the apex. Here's the thing. If it breaks higher above the apex, the rally tends to be very short-lived. If it breaks below the apex, the rally tends to be of greater magnitude. It played out perfectly to greater magnitude. So when it blew down there, it did exactly what it's supposed to. It blew up $1 on the breakout, but that's an inverted hammer, and that's a bearish reversal. And then it blew back down over here, to which it got another hammer, which was a bullish hammer, which is another reversal driving it higher. So if you ever see these formations of pennant, okay, try to avoid trading them. Let the price action play out. When it gets to the apex of the triangle, when it breaks in either direction, wait for about 20 or 30 minutes, then make the move. If it breaks underneath, it's a good short. If it breaks above, it tends to be a good long, but that long might be short-lived because the downside is usually much greater than the upside on that particular pennant formation. She spotted this, and I felt like at that point I was like, okay, I'm ready to retire. I'm done. Because when I can, through osmosis, communicate what I know into your brain, and rather than bringing you a fish, I teach you a fish, I can retire. You don't need me anymore because I taught you how to read the charts. When you can read the charts, you no longer need me. That's a fact. And that's what I teach people to do. Try to read the charts on your own, because if you can, then it's all worthwhile to invest in me for a lot of my webinars. Then you learn like how to read. Okay. One thing I know is you don't buy on the way down. You don't short on the way up. It never works. This is, I bought on the way down. Great. You just lost $3. Okay. Let it play out. Then it's bouncing. It's on the way up. There's the breakout. You could have added right there and rallied it up $3 or $4. It's a fact. But yes, this is a factoid. It is a pennant formation. I was extraordinarily impressed. And this is not one of the people who have been around Theo that long. So she obviously is really like, she's in a groove. She really gets what I teach, and I love that stuff. All right. I've got one more, and I'm done, and I'm going to roll out of here. Okay, the last one is this. The question is allocation logic. What's my allocation logic? Here it comes down to this. On a $100,000 account, you should not have any position, period, greater than 6 to 7%. And that is a risky push, a push. If you go through all my positioning in all my accounts, and I don't have as many, I blew out of 5 positions last week, 5. So at one point I had 15 long or 13 long. I'm down to about 8 long now. I'm actually getting way down the longs and trying to up the ante on the shorts. But I'm telling you this, I haven't got one position that I'm long or short, greater in my entire portfolio, greater than 6%. I have one at 5.7%, and it makes me like bat crazy nervous, like bat SHI nervous. I don't like it. I'm trying to get out of it. I'm trying to lower it. Okay. But it is what it is. I will not get above 6 to 7, or I will liquidate that position at least half or a third. Every time I get to a point where, when I usually get into a position, my allocation is 3% to 4%. When I get to 6 to 7%, I usually want out of almost all of it. When I get to 10%, I'm done completely, but it never gets to 10% because I won't let it. Fact of the matter is, and this is the secret sauce, and you need to take my Genesis Cog. Tomorrow there'll be a Genesis Cog sales webinar with Don. Me and Don will go back and forth. I'm telling you this. When people ask me, of all the things you've learned in 39 years, what's the most important thing I ever learned? Number 1, position sizing. It trumps everything. It trumps MACDs, technicals, fundamentals. None of that matters compared to position sizing. If your position sizing is wrong, good night, you're dead. You're dead. Position sizing. Number 1, you can't survive any market downturn without correct position sizing. It will never happen. You have a 0 chance of ever surviving. Position sizing. Number 1, never have a position, if you can help it, ever, above that 6, 7%, ever. Even 5% is a push. I've got 3 positions right now at 5%. Most of my positions are 3 to 4%. That's it. 3 to 4%. That's why I'm sitting on 50% cash, because I refuse to up the ante on position sizing. That's a lesson, because when markets go against you, the only thing that will ever save you is not it's not quote unquote bias. Your bias won't save you. Your MACDs won't save you. Your VIX, none of that's going to help you. It's your position sizing. You can withstand any market crash if your position sizing is small. And you can withstand any gamma squeeze if your position sizing is small. It's a fact. But if your position sizing is off, there is no tomorrow. On that note, I am done with my program here. I'm going to move this over to Mr. Brandon Chapman and let him run with this because I have to prepare for a Genesis COG at 11 o'clock. And this is a it is a nasty to Brandon. This is a bloody day. It's a bloody day. I admit it. I'm down about a 0.25% in my account. That's not bad.
No, it's not.
No, it's not bad, but I'm really like getting just completely out of twisted on one position, but every other position seems to be like holding as well as it could hold in an otherwise terrible market. And Brandon, here's what I'm seeing that really, really disturbs me. Stocks that are trading with PE multiples of 8 that are down 80% are being liquidated in massive trades. Like I'm looking at stocks down 8 and 9%, trading at 8 multiples, down 80% off the high.
Well, you get down to those multiples, really what it's a question of is the earnings potential, right? So, I mean, you get to a low PE. I mean, usually 6 is a major point, but we're basically saying, look, we're expecting your earnings to fall, right? So I don't today. I mean, we're gonna assess how bloody it is. I mean, how much more downside do we expect out of this? I mean, we're going to the vol markets really show this, but yeah, this is the point where you got to be, you got to either anticipate by having reduced position size or you just run headlong into the wall.
Yeah, and just to point out, like, I mean, what saved me was like I doubled up on my wall. I covered Walmart at 117, Brandon.
Mm-hmm.
I went back into Walmart today again at 121, and the risk reward was so good that I could not help myself to take it. Without that hedge, and that hedge is helping. Oh, I'd be down at least 0.5 to 1% today.
Yeah.
So, anyways. I'll let you run with this, Brandon. Brandon, right. I just say I would not buy this dip. Brandon, I would not buy this dip. Not.
Well, we're gonna give him 4 signs of a market bottom, and I'll just give you a prelude. We haven't hit it yet, so be careful of the downside still.
All right, see you, man. Bye.
All right, have a good one. All right, let's get rolling. So, as I mentioned, we're gonna talk about 4 signs of